Good morning, everybody. Welcome to our quarterly investment webinar. What do higher interest rates mean to you? My name is Erich Patten, CEO here at Cutler Investment Group. We're excited to have you here today and an opportunity to hear from our Chief Investment Officer, Erich Patten, on this important topic. He's also going to be talking a little bit about the markets in general, specifically focusing a little bit on the equity markets. So over the next half hour, if you have questions, feel free to enter them into the panel there on the Zoom interface. And if we don't have a chance to get to any questions at the end, please follow up with your advisor with any questions you may have. And we'll make sure to get Erich on the phone or one of us to answer your questions in a very specific manner. So with that, Erich, thank you for coming today.
Thank you very much, Matt, and thank you all for joining us today on the call. It is a beautiful sunny day in Seattle and a great day to talk about interest rates. So I will get started with the topic at hand. But first and foremost, we need to go to our disclosure page. Let's see, hold on one second. Obviously, in a group setting such as this, we're going to be providing forecasts and specific comments about the equity markets. They impact each of you differently. So please do not take this as actionable advice for you without talking with your financial advisor first. So moving on to the content now. There's really been a drumbeat of news out there about interest rates going higher. We sent out a webinar invitation last week with an article couched at the bottom of the email about the Fed raising rates. And here I provided a screenshot of a Wall Street Journal article from March. This was the day after the Fed's last meeting. And the headline reads, Fed signals more aggressive path. That's really been a theme ever since the Fed started raising rates. They just raised rates for the sixth time, raising the federal funds rate to 1.75%. This next chart really shows what the Fed is forecasting when they signal a more aggressive path, what that means. And the important dots to look at, this is called the Fed dot plot, are the red dots on this chart. And you can see what they do. This is a survey of all of the Federal Reserve governors. And they go to each governor and say, where do you think rates will be at the end of 2018? Where do you think they'll be at the end of 2019? Where do you think they'll be at the end of 2020? And what's your longer term view? And most interesting from this chart is there is a steady drumbeat higher. At the end of this year, the Federal Reserve Board of Governors is forecasting at least 3 interest rate, maybe 4 interest rate hikes this year, another 3 next year, and the year after that. When I'm looking at this, what I see is a Fed that does not think our economy is headed to recession. They don't believe that the growth that we're experiencing will slow down, because you don't raise rates when you're in a recessionary environment. That, to me, is a very bullish sign on economic growth. The market, however, it does not necessarily believe that the Fed's going to be able to execute this plan. And we'll talk a little bit about why and what that means. But this next slide shows, in essence, what the market is saying. An alternative title for this presentation, as I was putting it together, I thought, well, maybe we could call it Pushing a String. And this chart explains why. This is the yield curve. It shows the blue line is what that yield curve looked like a year ago. And the top 2 lines are a month ago as well as 2 days ago. And the yield curve is what interest rate you would get for, on the left side, a 3-month T-bill, all the way to the right side, a 30-year Treasury. And as you can see, the Fed has been pushing this string higher on the short end. The federal funds rate, which is the rate that I talked about on the previous 2 slides, is essentially the far left side of this graph. It's the overnight rate that banks lend to each other, and it's the bedrock interest rate of our economy. But as you push out farther, the Fed doesn't control the 30-year Treasury. In fact, the market controls the 30-year Treasury, and the market is not higher. In fact, March 31st of this year was lower than March 31st of the year before. So the Fed is trying to push rates higher, but they haven't been all that successful in doing so other than the short end. Another alternative title, and I promise this is the last alternative title, but when I think of the Fed pushing the string, it looks to me like a big ball of yarn. Everything is coalescing kind of in the middle of this kind of 3% range. The long end of the curve is at 3%. The short end is close to 2%. It's very tight. You also have really a coalescing around credit and around risk. And the way to think about that is treasuries are the highest quality credit out there. Still today, they're considered the risk-free rate of return because the U.S. government can always print money to pay their bills. But on the other end of the spectrum, you have junk bonds and junk debt, and the spreads between treasuries and junk bonds have also tightened. So investors are not being rewarded within the fixed income world of taking on any additional risk. You're not getting rewarded for going out longer term on the yield curve. You're not getting rewarded for taking on credit risk. And so we would caution fixed income investors to stay defensive and stay in those lower risk types of instruments. So the question that the Fed needs to ask and that investors need to ask is, why raise rates? If the bond market doesn't see long-term inflation, why would the Fed raise rates? And this next chart, I think, shows a little bit of why the Fed might be raising rates. This is a long-term chart from 1955 till today of the federal funds rate. And as you can see, even with the steady stream of rate increases that we've had since 2015, we're still at lows not seen since 1957. This is a very low rate environment and something that I would argue is very accommodative. It's an easy money policy still, despite the fact that the Fed has been raising rates. I'm sure lots of people on this call can remember that spike from 1980 when mortgage rates were upwards of 20%. We're nowhere near that today. So the Fed is trying to normalize rates and essentially give themselves another tool should the economy have a hiccup, should we have a recession. The Fed can't lower rates effectively unless they've already raised them back to a normalized level. Japan recently experimented with taking rates negative. I think that was widely reviewed as not a successful strategy. So the Fed is looking to give themselves some flexibility going forward. But the Fed really has two jobs. And I'm going to spend the next few slides talking about what those two jobs are. The first is full employment, and unemployment has been dropping ever since the Great Recession. Today's unemployment rate is at about 4.1%, which is near that full employment. So they're doing a great job of full employment. What they're also, I think, doing an excellent job of is stable inflation. And inflation does not present an argument for higher rates going forward. This is, when I talk about the flattening of the yield curve, this is really what is built into that flattening, is investors not seeing a lot of inflation. These two lines on this chart show the CPI, the Consumer Price Index, in white, and the federal funds rate in blue. And I think the important thing here is that they mirror each other. The Fed is targeting a 2 to 3% inflation rate. Right now we have CPI somewhere right or just higher than 2.1, 2.2%. And so sometimes the Fed gets ahead of this number, sometimes they lag behind, but ultimately the Fed is tracking inflation with the federal funds rate. What is inflation? Well, when we look at the components of inflation, it gives you an idea of what inflation actually is. And here on this chart, you can see that housing is an outsized component of the CPI. It's by far the most important component, and housing, the direction of housing is very important in determining what the Fed's going to do with interest rates. So let's look at that component of CPI and exactly how it's behaved. And I think this chart is the best explainer as to why the market does not see future inflation. We've seen shelter, which is highlighted on this chart. You can see the housing bust there when it fell dramatically from 2007 to 2010. And this is not just housing prices, this is the cost of shelter. So it includes rent, and it's a more broadly based measure of housing than just housing prices. But as you can see, it really leveled off in June of last year. It's at a nice 3% growth rate. That's right near the federal Board of Governors target for inflation, and it doesn't give a lot of impetus for the Fed for raising rates aggressively. So what does this mean? Most of our clients and most of us on the call here are savers. When I say savers, I mean you've got a 401k, you've got investments in the stock market, you've got cash in your checking account. Most of us in one component or another are either a saver or a debtor or both. Actually, most of us are both. What it means for savers is improved savings rates. CD rates are higher, money market rates are higher, savings accounts rates are higher. Those short-term investment vehicles are a lot more attractive today than they were a year ago. And if the Fed is successful at raising rates, and I think this year they will be, those short-term rates will continue to go higher. It also means a higher risk premium for equities. And equity investors are rewarded above and beyond the rates that they would get for cash or for bonds. You're not going to buy a stock if your bonds are going to yield the same amount because they have bonds have much lower risk. And I'll get into that a little bit as I recap what happened in the first quarter and we forecast going forward. So secondly, I'll talk a little bit about debtors. The yield curve is great news for most of us on this call. Our cash and our short-term instruments are having more attractive yields, and our costs of our long-term debt have not gone up. Really, the only component of the yield curve, or the only impact that it might have a negative impact, is small business credit financing. If you have a revolving line of credit or something that's tied to short-term rates, those costs have gone higher. But for the most part, borrowing costs have not gone higher for most debtors. Mortgage financing is still attractive. The 30-year fixed is right around 4.5%. Jumbo rates near 5%. When I talk about that ball of yarn, mortgage rates, it's easy to understand that taking out a 30-year fixed is not, you're not being penalized much for extending the terms of your mortgage. So let's move on to our market outlook, our first quarter review, and some forecasting for going forward. And I think the first quarter can really be couched in the context of three surprises. The first surprise is lower interest rates. And I put lower in italics because it's a little bit tongue-in-cheek. Obviously, short-term rates have gone higher. We've talked extensively about that. But long-term rates have not moved. And year over year, they actually were ever so slightly lower on the 30-year Treasury than they were on March 31st of the year before. And I think that's a little bit of a surprise for investors. This chart shows the 30-year fixed, and it's been in a range of about 2.75 to 3.25. And there was a great deal of dislocation that happened in February. You'll see that really as the year 2017 turned to 2018, we were near the low end of the range, and then we really pushed through a high end of the range. We've since sold back down to about right around 3%. And the reason for that move was that we saw some numbers in February that scared bond investors a little bit. The wage numbers came out higher than expected, and people felt that all of a sudden maybe there are some inflation pressures building into the economy, and then that longer rates would have to go higher. Well, that data has since been revised lower. The market has normalized, but it has created a different equity market at the back end of this news than we had in January, and I'll explain that in the subsequent charts. So the first surprise, lower interest rates. The second surprise, volatility is back. We did not see really any volatility in 2017. The market did not present many buying opportunities at all for investors. In fact, we had not had a correction since the presidential election in 2016. We now have had a market correction, and this chart is a pretty dramatic way of looking at the return of volatility in the first quarter. This is a chart of a daily inverse volatility fund, which is a very complex thing to say, a complex instrument, but it's a bet that investors were making that volatility would stay low. This fund had $2 billion in it in January. When that wage inflation number came out, bond yields spiked, stocks sold off, and this fund had a very dramatic loss. It lost 83% in a day, and actually the fund company subsequently announced that they were going to close that fund and liquidate it altogether. So $2 billion was effectively wiped off the map because of the return of volatility. This isn't really a surprise. Volatility had been at historic lows. Investors should have been anticipating some return of volatility to the markets. And stocks had rallied very significantly in January. They sold off about 10% on that wage news and have since stabilized a little bit. That 10% correction really has led us to surprise number 3. And that's what I'll call a valuation opportunity. Investors, ourselves included, had spent a great deal of last year talking about how expensive stocks were. The headline valuation metric, I would call it the cyclically adjusted PE ratio, also called the Shiller PE ratio, was showing stocks at highs not seen since the tech bubble and also not seen since the Great Depression back in 1929. That metric takes 10 years of earnings and divides them into the S&P. And we all know what's happened in the last 10 years. There's been 2 significant events that really have impacted earnings. The first was the Great Recession, where the financial sector earnings cratered, and the second was a drop in oil prices, where the energy sector earnings cratered. Both of those 2 sectors have recovered very significantly, and so we think that that measure is not the most accurate measure of valuation today. We would use a more traditional PE ratio, which I've included on this chart. And traditionally, the price to earnings ratio of the S&P is right around 15. Today, we're just under 17. But in January, we were at 19. Stocks looked very expensive on this measure in January after that run-up that we saw where stocks had gone up fairly significantly. That 10% correction has brought stocks back to a reasonable valuation. We think interest rates can stay low. We think the market is more correct than the Fed in terms of forecasting interest rates. And so there is a price to earnings ratio premium justified in the market above the 15. So we would explain some of this premium because we're in a low interest rate environment. However, it is much more attractive today given 3 factors. The first factor is earnings are growing very significantly. So earnings in the first quarter are forecast to be up about 17% over 2017. That growth rate is phenomenal. The second component of that growth rate is the tax reform package. The tax reform package contributed about 10% to this quarter's earnings. So overnight, stocks looked about 10% cheaper than they did in December after that tax reform package passed. And the third explanation for why we think there's a premium justified in the S&P 500 today is that the economy continues to grow, earnings are continuing to grow. So today's earnings are estimated for the current year to be about $157 in the aggregate for the S&P 500. That represents 17% higher than the previous year. Looking into 2019, that could be as high as $170 in the aggregate for the S&P 500, which would be about a 15 times multiple. That begins to look fairly attractive when you're an equity market investor and you can forecast not too far in the distant future for attractive valuations. For that reason, we believe that you can be comfortable being an equity market investor today. We are buyers of equities at these levels. We think that this sell-off has given investors an opportunity to re-enter the equity markets if they've been sitting in cash or if they have a bond position that they'd like to reallocate into equities, and we'd be comfortable owning equities for the remainder of 2018. So with that, I'd like to thank you for your time. Again, if you do have questions about Cutler's view on the markets of where we think things are headed, or specific questions about this presentation you'd like to talk through, please do not hesitate to reach out to your financial advisor. Also, do not hesitate to reach out to myself directly if you'd like to talk about it further. Thank you for your time, and we appreciate you calling in today.
Thank you, everybody. This concludes our first quarter investment update. Eric, thank you for your thoughts, and we will have this posted to the website, cutler.com, shortly. Have a great day.